In this video, we're taking a look at net realizable value analysis, or NRV analysis, which is the main tool that businesses use when evaluating whether their inventory is priced at the correct value. Whether you work in finance or accounting, being able to do NRV analysis is a really powerful thing that you can add to your tool belt. Now, before we open Excel and go through a practical example, let's see what the net realizable value is all about.
First, let's take a look at what is NRV, net realizable value. In order to calculate that, we need to figure out what's the estimated selling price or the current market value that we can realize the specific asset at. And then we also need all the associated selling costs like marketing, delivery, stuff like that. And the difference between two is our NRV, the net realizable value. If you're working with US GAAP, there it doesn't specifically refer to NRV. Instead, it talks about market value and it has a ceiling and a floor. So under US GAAP, we have to present assets at market value, which is below or equal to NRV and above or equal to NRV minus the normal profit margins. Both of those are easy to calculate once you're able to figure out the different pieces. Unfortunately, in a lot of situations, they are a bit subjective. Although this is for assets and for inventory, we can easily apply the same concept for, let's say, receivables. In this case, the net realizable value of our receivables will be our gross balance minus our doubtful debt allowance. And if you want to learn more about the doubtful debt allowance, I'm going to link to a video that explains how to perform an accounts receivable aging analysis and how to calculate the doubtful debt allowance provision. In terms of accounting records, those are fairly simple. So as soon as we identify that our inventory is actually down in value, so we're not expecting to realize the amount at which we have it booked on our balance sheet, we can recognize an expense on inventory write-down against an inventory NRV allowance. So we're still not writing down inventory itself. We are recognizing a provision essentially, but we are recognizing the expense in this period. Then, for example, imagine that now this is all certain. So this inventory has become obsolete. Maybe there's a new production process from our supplier and this inventory cannot be used anymore. So now we have to write it off. We're going to recognize an additional expense for $15,000 and we're going to utilize our NRV allowance that we previously recognized. That way the total amount that has gone through this expense will be $20,000, and this is how much we're going to write off of inventory. And the point here is that more often than not, those two steps would happen into different periods. So as soon as we identify potential obsolescence, we are recognizing our NRV allowance in the previous period, and that way this expense goes into this previous period, and then in the following period we have the rest of the expense. So the expense essentially follows when we realize that this is going to happen. There's another option. Let's say, for example, we manage to sell this unusable inventory for $12,000. Then we'll have cash $12,000, or this can be like an accounts receivable from a customer, but let's say it's directly cash. We can also realize our allowance, and the difference is going to be the additional expense of inventory write-down. And against that, we'll credit our inventory with the $20,000 in question. On the other hand, if let's say this supplier fails and our inventory is actually not obsolete, it goes back up in value, then we can decrease our inventory NRV allowance by debiting it, so we can close the credit balance, and we can recognize other income at the time when we realize that it's going back up in value. And keep in mind here that while IFRS allows reversing write-downs, US GAAP does not. So keep that in mind based on which standards you're applying. Here in Excel, I have this breakdown of inventory at the end of the year, and then I have the sales in the subsequent quarter. So the way I'm going to approach this is I want to make sure that those are not overstated. And one good way to perform this analysis is to compare those to actual selling prices that we achieved recently. First, I'm going to calculate cost per item, which is going to be my value divided over my quantity. Then I'm going to look up the sold value, Q1 25. And I'm also going to do the sold units, Q1 25. Okay, let's VLOOKUP those. I'm going to VLOOKUP item ID. I'm going to go here, grab this, and look at net sales. So there's a debate that can be had whether we should look at gross sales or net sales, because net sales are discounted. I would prefer to look at net sales because usually if we discounted this, for example, by 10% to be able to sell it in Q1, then we'll probably have to discount it in the future as well. Okay, so we're gonna grab the net sales. This is my 6th column, and I want an exact match. And then for the sold units, I'm gonna do the same, VLOOKUP item ID, and I'm gonna grab the sold quantity in Q1, the 2nd column, and I'm going to calculate the sales price, which is going to be the sold value over the sold quantity. You can immediately see that this sales price is more than the cost per item, which means that we're still able to realize this item at a value that's above its cost. So it's okay, it doesn't need to be written down. There's no indication of the value being below what we have on the books. Now we're going to see if we have any NRV issues. The way we're going to calculate this is first we're going to say if the sold units is 0, then we're going to say no sales. Otherwise, we're going to do another check and say if our cost per item is above our sales price, then we want this difference. Otherwise, we want 0. Okay, and now let's copy all those down. The way down, you see here we have some that have no sales, and we also have some where the current value is above what we were able to sell them at. Let's calculate our NRV adjustment, and this is going to be if this is a number, if is number, this here, the NRV issues, then we want to grab this multiplied by our available quantity, because this issue is per item. Otherwise, we want 0. Copy that down, and now we can, let's add a row up here and have this be a sum of all those. You see we have 1.1 million of NRV adjustment that we need to do, which is out of 100 and almost 10 million. So about 1% of our inventory value needs to be adjusted. But you see we have those where we have no sales. So what can we do about those? What I usually do is, you see here that I have groups. So I'll see if I have NRV issues within the same group and apply the same percentage of the NRV adjustment to those items that don't have any sales, and we don't have any way to see if their value is reasonable. What I'll do is I'll grab all this, add a pivot table, and here I have the group. I'm going to have the sum of the value at the end of the year, and I'm also going to have the sum of the NRV adjustment. Okay, let's make those numbers, and here I'll simply calculate C4 over B4, which is going to be the percentage of my NRV adjustment for each of those groups. Let's show a bit more. So you see, for example, in BKG group, we have about 4% of adjustment. So back here, I'm going to say additional NRV adjustment percentage, and this is going to be VLOOKUP, the group ID, and here I'm going to select the groups to the fourth column, K0, and I don't want this to be applied everywhere because I might already have an adjustment and I don't want to adjust it again. So what I'll do is I'll simply wrap this whole thing in an if statement, which is simply going to say if this equals no sales, then do this, otherwise give me 0. Gonna copy that down, turn it into a percentage. I'm actually gonna turn it into a number so it's cleaner where we don't have anything. And then I'm gonna say additional NRV adjustment, which will be this multiplied by my value at the end of the year. Gonna copy that down, and this would give me some additional amounts as an NRV adjustment. You see about 140,000. Then my total NRV adjustment, and this is what we're after. It would be the NRV adjustment plus the additional NRV adjustment. Copy that down, and let's see the total. So this is the column, and this is the amount that we were looking for. This essentially shows us that although our inventory is valued at 109 million on our balance sheet, in essence its net realizable value, or as much as we can estimate it, is about a million point two below that, which means that we're overstating inventory on our balance sheet. And this is where we'll apply this here and take such a journal entry to make sure that we are decreasing inventory by adding this inventory NRV allowance. So this will be a negative account, a credit account, but in presentation on our financial statement is gonna be summed with our inventory debit accounts. So it would essentially decrease the value of inventory on our balance sheet.
Thanks for watching. I hope this video gave you a solid understanding of how to perform NRV analysis in Excel. If you want to learn more about financial modeling, I've created a beginner-friendly 5-hour financial modeling course available absolutely for free right here on YouTube. And you can check it out in this playlist up here. It will take you from an empty Excel spreadsheet all the way through to a fully built 5-year financial model that you can use for any business. Thanks for watching, and I'll see you in the first video.